Well, the Fed clearly is willing to roll the dice. The futures market is now priced 100% of the way for another 75 beeper on July 27th, fully priced for 50 basis points in September, and another 50 basis points at the November meeting. And all of this into an inverted yield curve and what is still classified as a fundamental bear market in equities and now most commodities. We have a Fed that is focused on contemporaneous or lagging indicators, and the fact that all that matters is getting inflation back to 2% is akin to having the oil price as your principal price target. Anyways, this means that along with the impact of QT, the Fed this year will have tightened policy the equivalent of 450 basis points, which was last accomplished this quickly by Paul Volcker in the early 80s, when we had two recessions separated exactly 12 months apart. There was nothing in the employment data for June to knock me off the recession call, and I'll get into that in a second. First, I suggest we pay some respect to the most important market development in the past few weeks, outside of the sudden reemergence of the inverted 2s10s Treasury curve, which is this 30 basis point inversion of the Fed futures strip between the December 2022 and December 2023 contracts. Over the past month, this spread between the two contracts has swung from nearly plus 50 basis points to nearly negative 30 basis points today. We haven't seen this since the Powell pivot in early 2019, and before that, in 2007, when Bernanke did begin to realize that yes, home prices can indeed decline nationwide, and that no, the problems of subprime were not going to be contained. So someone out there believes the Fed is going to be successful in crushing inflation to the point where the Fed cuts rates sooner than most people believe, which is in the end going to be majorly bullish for the Treasury market and likely kibosh this turbocharged US dollar, maybe the most overcrowded trade out there, and that would be very bullish for gold, which has been languishing recently. But we have the most acute tightening in fiscal and monetary policy in tandem for any year in the past 6 decades, and the economic intelligentsia still has inflation on the brain as they focus on the past 18 months, which, as an aside, will go down in the annals of history as being fitting the label as transitory. Though, you use that word today and people look at you or me as having either leprosy or lobotomy, but nobody, it seems to me, talks about the money supply anymore. And yet here we have the narrow M1 measure of money flat in May after it contracted negative 0.4% in April, and the 3-month trend in M1 is running at minus 2.2% at an annual rate. We last saw this in March of 2019, and it stopped the hawkish Fed right in its tracks. The year-over-year trend has now receded for 9 straight months. It was at a 17% peak last August, and now it's all the way down to 7% in May, which takes us pretty well to where we were back in February of 2020. And the same holds true for the broader M2 money measure. It was flat in May, negative 0.4 in April. The 3-month trend is basically zero, and the year-over-year trend, just like M1, down to 8% in April, now down to 6.6% in May, back to where it was pre-COVID. That is an epic slowing in the money supply, and everybody seems to still have inflation on the brain. Now, the real kicker is what's happening to the root of monetary creation, which is the growth in base money, bank reserves, and currency in circulation. The monetary base contracted negative 4.8% in May. After being down 6% in April, it's down 5 months in a row. Last August at the peak, the year-over-year trend was 32%. Today, it's deeply negative. And then you take a look at this monetary policy tightening in the context of the deflationary pressure emerging from the tighter fiscal policy, and we have the makings for a recession in the second half of this year. I think it's just starting. Now, when we're taking a look at the broad commodity prices, we also have to assess that we have deflation across the base metals, across the food complex now, and it's morphed even into the energy side. So, from my lens, the recessionary bear market in equities is intact, notwithstanding the intermittent rallies that we're seeing. The yield curve has inverted again. The bond market next year is saying that the Fed is going to be forced to cut interest rates. And all these market signals is telling me that the recession call is becoming more ironclad by the day, which means to me, when I'm looking at all the tea leaves, that we're basically at this point halfway done in this bear market in equities and corporate credit, and only likely one third of the way through this new cyclical bull market in treasuries.